Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
Let's talk retail stocks because they certainly got a boost today as the latest read on U.S. retail sales, excluding the impact of that cyber attack on auto dealerships that we talked so much about, rose in June by the most in 3 months, Carol, as sign consumers regained their footing at the end of Q2.
Yeah, and just a little bit more detail of the 13 categories that are tracked by the Commerce Department, only 3 registered declines. Those included sales of gasoline, reflecting lower prices in the month. Sales at sporting goods stores also edging lower. So a little bit of context there. What you need to know, we want to get to that now that we've had a few hours to digest that retail sales report. Washington, D.C. Bureau, that's where we go, and to Bloomberg News, U.S. Treasury and Economic Policy reporter Chris Condon. Hey, Chris, good to be checking in with you. What do we need to take note of from this morning's retail sales report, other than it was a surprise to the upside?
Hi there, Carol. Yeah, the first thing, in which you've already noted, is to throw out the headline number. It was distorted by the auto issue that affected auto dealers. The underlying numbers were really good. Ex-autos up 0.4%, and going further, ex-autos and gasoline. Gasoline fell mostly because of a fall in prices, not less demand. Take those out, there's your number, 0.8. That's quite strong, much better than expected, and it finishes off the quarter on a pretty sound note. Now, more broadly, I would hesitate to make any big conclusion about a full recovery of the consumer. The broader trend is for cooling consumption, cooling demand. Obviously, the consumer and businesses are under pressure from high interest rates. We're seeing that across the labor market. So that's going to further erode purchasing power. We're seeing more consumers in some level of debt distress. In a way, I would say the Fed is getting exactly what they want, an incremental, gradual slowing of demand. It's helping to reduce inflation, but not so much that we're hitting some kind of dramatic tipping point. And in the June strong retail numbers kind of reinforce that idea that we're not tipping over into a more dangerous period quite yet.
So if you're Fed Chair Jay Powell, we heard from him yesterday at the Economic Club of Washington, Chris. You talk about repeatedly every day how data dependent you are. How do you take this bit of data?
Well, rule of thumb number one is it's just one piece of data. They're going to incorporate it into a bigger sphere of numbers that they're looking at. And even within consumption, the retail sales is largely focused on goods. It's not really a comprehensive take on demand from consumers. So they'll take that on board, but I don't think it's likely to deter them from that feeling that they are getting closer to a rate cut. Now, it doesn't sound like they're on the cusp of, say, a July rate cut. There's no real firm signal of that. It does sound increasingly like a September cut is likely. Today's number is, going to reinforce the idea that certainly July is not yet appropriate, but the overall trend, as I said, is moving them closer and closer to a September cut.
It's an interesting environment, no doubt about it. We're going to talk, Tim and I, a little bit later on. Claire Ballantyne of Bloomberg News has a story about car repossessions surging 23%, so rocketing higher in the first half of the year. And it's just another sign of consumer distress as we've seen, either higher interest rates making payments more difficult. So you would say glass more half empty when it comes to consumers at this point?
Yeah, as you say, that's another sign of distress. We're seeing credit card balances ramp up. But, I would come back to the point, Carol, that these are the things that you do expect when the Fed has a restrictive policy in place. And it's not so bad that we're seeing a spike in unemployment or any cratering in overall demand that would indicate a policy mistake has already been committed and that the Fed is going to really have to start cutting dramatically. No, they are closing in. They're not quite there yet, but they are closing in on that soft landing. There will be pain along the way on the margins increasingly. But so far, so good, I think, for the Fed. And pretty soon, I think some consumers are going to start to see some relief, not only in lower inflation, but lower interest rates. How long that takes to feed its way through to lower credit card rates is another question, but some relief perhaps on the way.
Chris, inflation's still not at the levels the Fed wants to see, that elusive 2% at this point. What economic metrics, though, are seeing a normalization? Take into account like pre-COVID levels. Where are we seeing things normalize and where are things not normalizing?
Well, if I'm thinking of the bigger picture here, it's very difficult even to draw some conclusions yet. From the Fed's perspective, they're going to be wondering where do long-run rates normalize? And that is still very much an unanswered question, a question they're going to have to confront in the coming months. They're starting a new, what they call a framework review, and they're going to have to very publicly confront this question. And so far, it does seem like long-run neutral interest rates are much higher than they were before the pandemic. Will they return? Still, like I said, an unanswered question that economists are grappling with.
Well, and it's certainly something, too, those who invest in the banking sector are grappling with, which is where we want to go right now. Chris, thank you so much. Always appreciate it. Chris Condon, he's U.S. Treasury and Economic Policy Reporter at Bloomberg News there in our D.C. bureau. So let's talk about the continuation of big bank earnings that came out earlier today. Morgan Stanley and Bank of America reporting quarterly results this morning. Both stocks did rally for much of the day. Morgan, though, losing most of its earlier gains, still up just shy of 1%. B of A still up, Tim, about 5% in today's session.
And again, we're going to be hearing from Brian Moynihan over at B of A in just a few minutes. Before we get there, though, let's check in on what these stocks did and what these banks reported. Morgan Stanley, like its rival Goldman Sachs and JP Morgan, beat expectations. It solidified the market's business as a hotspot across the industry. Investment banking fees, Carol, also increased. They soared 51% from a year earlier.
And then B of A, we saw their stock hitting, I think it was a 2-year high during the day after it reported trading and investment banking results that topped analyst estimates. Also gave a forecast for net interest income, very key, and B of A's biggest source of revenue that also exceeded expectations. So let's get to it. Anton Schutz is back with us, President and Chief Investment Officer at Mendon Capital Advisors. He joins us from Florida. His RMB Mendon Financial Services Fund, by the way, up nearly 16% in the past month, putting it in the 90th percentile among its peers, according to Bloomberg data. The fund up 26% in the past 1 year, putting it in the 36th percentile in this category, again, according to our data. Anton, good to have you back with us. How are you?
Well, it's been busy, for sure. Always a crazy time, and we've added craziness.
Yeah, it's crazy on top of crazy on top of crazy. But let's talk bank earnings, if we may. Morgan Stanley, B of A, let's start there. Investors seem to, for the most part, like what they heard, especially from B of A. Are these results investable? Should investors be acting on these results, in your view?
Well, I think people have been negative on B of A for quite some time. It's got a very large bond portfolio. It kept talking about the bottom and net interest margin. And here we are. We're at the bottom of net interest margin. They're actually guiding higher. And obviously, as the bond portfolio, starts getting longer in the tooth, the losses on it, get smaller. If interest rates drop, which people are thinking about, again, the losses could, get smaller, maybe potentially even turn into gains over some period of time. So I think, people may have been short Bank of America. And clearly, at this point, there's a lot more comfort in the banks in general. And then, also since the debate, the financials have had a very strong performance because the Trump administration is seen as friendlier towards banks.
Are you buying that trade?
Well,
would you suggest others buy that trade?
Banks.
I guess. I know.
Well, I guess I've said for some period of time to people who are willing to listen to me, which, again, when you're out of favor, people aren't willing to listen. But I've said that, buying my fund is like buying a call option, really, without a cost to it at the time because valuations were so cheap on if Trump wins. And it just going back to November 16, that month, banks were up 16%. Now, there was a tax cut in the offing, but from a regulatory perspective, I think, deals getting approved. Again, people expect that administration will be friendlier towards M&A. And clearly, M&A has been way down in the space.
Anton, I love asking about the consumer. Carol knows that I sound like a broken record, but one of the reasons I love hearing from Bank of America is because they have such a good eye on what the consumer is doing, how the consumer is feeling. We just talked retail sales. We're going to talk a little later about auto defaults. What idea or what picture of the consumer did we get from Bank of America earnings today?
Well, I mean, we got a pretty good picture. I think they're not going down the food chain into the subprime space, because I think that consumer in particular is hurting a great deal. I think the stimulus money's gone. I think the employment picture is getting tougher for them. Inflation is biting hard. So I'm negative on the subprime consumer. And I think if you look at the, sort of the middle income part of the population, I mean, you can see it in restaurant statistics that sort of the full service restaurants are sort of struggling to, gain that consumer. You've seen even some of the lower end stuff like Red Lobster, getting in a lot of trouble.
Yeah, exactly. All right. So, B of A, we had Morgan Stanley today, but wrap it up for us. We had Goldman Sachs yesterday, and I know you do focus on kind of the smaller mid-cap names, Anton, but I do appreciate your insight when it comes to some of the big cap names. JP Morgan, of course, last week, Citigroup, and Wells Fargo. Are there any trends, takeaways in terms of the overall banking sector, what we're seeing in lending, some of the commentary, what it kind of says about this environment right now?
All right, I'll take up the rest of the show now.
All yours.
Yeah, really. I mean, look, first of all, the one thing we didn't see was credit problems. And everybody keeps harping, boy, we're going to have all this trouble in the banking system from real estate. And, they've reserved a lot. And, we're seeing losses. Bank of America actually said commercial real estate losses will be lower in the second half of the year. Fascinating, right? Secondly, loan growth is slow. Right? We got a slowing economy. We just talked about it. You had an economist on, economy's slowing. I think the Fed is behind. I wish they would get started. But September appears to be in the cards, but they need to get going. The economy's slowing. There's no loan growth. So what do banks have? If there's no loan growth, earnings are fine. Capital grows. They buy back stock. Maybe they start buying each other. That's what happens when you don't have any loan growth. And credit quality is fine. I mean, they've done a nice job. They've been very conservative, really, since COVID. And this is not 2007 and 8. And I keep saying that, but it's not. It's not showing up.
Well, why do you think the Fed is behind?
Because there's such a lag to them moving rates, right? When they raise rates, it takes a long time for it to take effect. When they lower rates, same thing. It's not like 25 basis points is going to change anybody's economic behavior or viability. So, my guess is they tiptoe and give us 25s for a while, but that's pushing on a string early on. So it takes time for all those effects to take hold, for financing to become more attractive for people to be able to refinance or invest in new projects. So, yeah, they've got to get going if the economy's slowing.
When does it start to concern you that they haven't gotten going yet?
Well, I mean, I'm already concerned. I think they're already late. If you think about unemployment, I mean, where do we bottom? 3.4. We're at 4.1. And if you look at different statistics, things like the household survey, the numbers are not as rosy on the employment side. So I think they've got work to do.
I do wonder too, Anton, when you look at the space, what is your favorite, first of all, big bank? What's your favorite other bank, if you will, in the space?
Okay.
And why? Yeah.
All right. Well, I've always loved geography. So again, I'm going to talk about the Southeast and Tennessee. So First Horizon, it's a pretty good sized bank, right? It's just under 100 billion in size. They had agreed to sell the TD years ago. The deal got scuttled. TD got in some trouble. I think that company is doing well fundamentally. I think they're in great markets, and potentially someone else could go, I'd love to be in those markets as well. So I think operationally they're great, and I think fundamentally, and they're attractive. So, if you go down the food chain, and I think I may have talked about it before, but First Bank in Mississippi, they're in Georgia and Mississippi and Florida. So, two states that are really growing well. And Mississippi, by the way, has a lower unemployment rate than Texas.
First Horizon, by the way, is one of the top holdings. It's number 9 in your fund. It's about 4% of your fund. Anton, what about banks that you want to stay away from? You said, well, correct me if I'm wrong, but I believe you said that we might still see some shakeup in some of the regional banks when it comes to real estate. So
sure.
Yeah. So which ones do you want to avoid as a result of that?
Yeah, I'm not seeing a lot of failure. So first of all, let me not say that that you should go out and short a bunch of banks that have a lot of real estate exposure. But there will be some losses. Things like life sciences, right? That was a hot area to lend into. It's not a good area right now. So people who have exposure to things like that, are at risk. If you saw some downgrades on things like Bank of the Ozarks a month ago, I mean, interesting earnings to look at. I really respect the CEO, but he's got a lot of real exposure to things like that.
I do wonder too, in terms of what the Fed does or doesn't do you think, we've been talking a lot about politics, and are you concerned that the Fed gets caught up in some of the political environment and maybe doesn't do, as you said, I think that they're already behind the curve. Are you concerned that they get caught up in that and maybe, don't move as fast as they're already behind the curve according to you. So do you think they kind of get caught up in that?
Well, I think they had gotten caught up. I mean, I think they acted a little late in raising rates. I think Chairman Powell was waiting to get reappointed. So that transitory thing on inflation was bad. President Biden has promised a rate cut, some months ago, so the Fed is going to cut rates. Well, there's a little bit of pressure. He hasn't said anything lately, but
yeah.
At this point, he's behind in the polls. A lot of the people at the Fed have been appointed by him. So we can say the Fed's not a political organization, but certainly people are going to have some loyalty to him, and he's behind in the polls. So I suspect there'll be pressure on the Fed to cut rates by the administration if we get any more bad economic statistics.
Anton, one last question. We're getting ready to hear from the CEO of Bank of America, or David Westing, sitting down with him in just a moment. What would be your top question to him? What's top of mind for you?
Well, look, I'm a big fan of Brian Moynihan's. I mean, it was just amazing watching him take the reign after the financial crisis. So, the big question is what's next, right? He can't grow the company anymore from a depository perspective. What other lines of business would he like to be in? Does he want to continue to build out, the wealth management product? Does he want to continue to build out, other lines of business? And by the way, how is he using technology? Because technology is going to be the biggest driver of efficiency ratios in this industry. AI is enormous for anybody that has all those back office jobs like the big banks do.
All right, going to leave it on that note. Around the world of banking we went, as we always do. Anton, thank you so much. Be well. Have a good summer. Anton Schutz, he's President and Chief Investment Officer at Mendon Capital Advisors.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
All right, let's talk a little bit more about politics, certainly front and center. Donald Trump, of course, as you know, made his first public appearance since an assassination attempt. That was last night. White bandage covering his right ear as Republicans gathered to nominate him as their presidential candidate for a third time.
We didn't hear from the former president, but the through line of his populist doctrine was evident, from tapping Ohio Senator J.D. Vance as his running mate to the spate of speakers, which range from business executives to the head of the influential Teamsters Union. We even heard from David Sachs, the venture capitalist who we were talking about a little earlier. A
broad spectrum of speakers. So what will the race and run up to the November elections mean for investors short and longer term? To tackle that, with us is Kara Murphy. She's Chief Investment Officer at the Registered Investment Advisor, Kestra Investment Management, joining us right here in our studio. Kara, welcome.
Thank you.
Nice to have you here. Nothing going on.
Yeah, very quiet.
It's very quiet. Hey, remind us, we often, we'll talk about this, some of our Bloomberg Market write-up stories or write-ups on the markets. We'll talk, remind everybody about kind of historically what happens in a presidential year. Remind us a little bit about that.
Well, number one, there's always a lot of fretting, a lot of hand-wringing, a lot of worrying. But what's interesting is that when we actually look at market performance in years when there's a presidential election, the annual return is remarkably similar to non-election years. But the way that we get there is a little bit different. And typically what we see is a kick up in volatility late in the summer prior to the election, and then markets sort of take off before the election actually happens. So we've been counseling people to be aware of this. It can still be a really good market environment, but it can be a bumpy road along the way.
It hasn't been that bumpy over the last
You're right.
18 months.
And so this is where we also have to be cautioned, because this year is so different in so many different ways. And I think part of the reason why markets have been able to rally in the first half of the year is because I know it doesn't feel this way, but there's actually much less uncertainty going into this election than what we normally have. Especially
Meaning what? Meaning what specifically?
And especially after a weekend like we just had, that sounds weird. But we have two former presidents who are running against each other. We've never had that before. So the two presumptive candidates, we know what they do in office. We know who they surround themselves with. We know what policies they favor. We've actually never had that level of policy certainty going into an election. So from a market's perspective, that's actually a good thing.
Do you believe, though, as someone who has to advise investors, that a second Donald Trump term would be just like his first term?
So that's always a big question. And again, just because he served 4 years doesn't mean the next 4 years are going to be exactly like it.
It's fair to say, and this isn't being political, but he's not your standard political candidate.
He's also, a lot of the people who were in his universe in his first term are, no question, out of his universe forever.
Right, what people have been calling kind of the guardrails in that first administration.
But we also see, even in a Biden administration or other administrations, you tend to see every couple of years a big turnover in terms of the personalities around a president. We also have this wonderful thing in the United States called political institutions, which themselves provide guardrails and limit the amount that any one executive can do.
But you have a potential president, meaning Donald Trump, who says he wants to undo those institutions and take away kind of the structure that has been entrenched, and in many ways, the checks and balances throughout the government. So how do you kind of think about that?
And I think that is a very real challenge. But as we've looked through, we're still relying on Congress to make policy. We're still relying on courts to make judgments. And we might disagree with what those are, but we're still working through that system. And so I'm not calling the end of the American institutions just yet.
What do you see as potentially inflationary about another Trump administration? We've talked a lot about this, the idea that he is interested in raising tariffs. There are some questions about other policies that would actually be inflationary. How are you thinking about that?
Well, I think when we look at both potential administrations, both have potentially inflationary policies. And so for Trump, it's more along the lines of tax cuts and tariffs, which, in some ways the market likes, right? The market likes when companies pay fewer taxes, but can actually be inflationary. So I think those are components to a broader picture, but there are certainly broader economic forces that'll play into inflation than just policy.
So what do you tell investors when someone comes and says, Kara, okay, I want to put some money to work. Do I play it safe, keep it in cash right now and wait to see what happens? What do you say?
I think if investors play it too safe, they risk missing a really good market environment. So what we would say is diversification is still your best friend, right? You don't have to own just a handful of companies. You can diversify, whether it's smaller cap names outside the US, bonds. So there are a lot of different ways that you can still be invested, enjoy a good market environment, but without being so beholden to just a few names.
Would you play the Trump trade right now? Which is everybody was kind of jumping on. And I think Tim and I talked a lot about this of being like a little careful one day. We still have a few months to go before the November election, but whether it was prisons, gun stocks, crypto.
Yeah, those were all higher. We had oil stocks. We actually had clean energy stocks and green stocks move lower yesterday. So it's like the classic Trump trade.
So I think often when we look at policy baskets in previous presidential elections, they haven't been very easy to trade. You'll have these little blips where those types of companies outperform, but then they kind of come back down to earth. So I'm actually not a big fan of playing individual stocks because, as you pointed out, there's also a lot of policy uncertainty, even with two men who have already served as president.
Well, a lot of the policy uncertainty comes from what happens in the House and Senate because, we talked about the idea of gridlock. And if there is a mixed Congress, or if the president is one party but Congress is another party, then you could see gridlock. How do you think about that?
The market usually likes gridlock. They usually like Washington not being able to get a lot of things done. So that's not a bad scenario.
But what's the scenario that you're playing out right now?
So we're looking beyond the election. We're looking at where we think the U.S. economy is going, and we think that the U.S. economy is slowing, but in a good way. Inflation is coming down. You have the boost of the Fed rate cuts, and I think that actually is a much more important driver of the market than who's going to be in the White House in January.
Kara, okay? So it sounds like you look through who is ultimately going to be in the White House.
We do.
What's the risk, though, in looking through and missing something that could be dramatically different?
Well, there are a lot of risks, right? So as an investor, you're always waking up at night thinking about different potential risks. But I think the biggest risk that we face is something that's more intrinsic to the US economy, right? So maybe the Fed doesn't cut enough and rates stay too high for longer, and we start to see, let's say, a crisis in commercial real estate. So I think those are much easier to kind of identify and then also hedge against, rather than some huge policy mistake that ends up coming out of the White House.
You mentioned commercial real estate. What else do investors have to have on their radar that could be on this bumpy road that you alluded to?
So the other thing that we focus on a lot is the Mag 7, right? That's all
Yeah.
anybody's been able to talk about for the last year and a half. And what we have found is that portfolios have become increasingly concentrated in just a handful of names. And then you end up being very over-levered to things like mega cap and growth. So a lot of people who think they're very core actually aren't necessarily very core.
So does that make it a prime time? I mean, we talked a little bit about geographic diversification, but the U.S. has outperformed global stocks for years at this point.
Yeah.
When is there going to be opportunity outside of the U.S.?
That's the golden question.
I mean, if there's so much concentration risk here in the U.S., then it sounds like you're saying now.
Well, we think it's always important to have, non-U.S. stocks in your portfolio, but it becomes harder every year that the S&P outperforms. But we think it's even more imperative today than it was, say, 5 years ago, for all the same reasons. Because you get diversification, you have different growth pictures, you have lower valuations, and they act differently. And then if you're worried about political risk, then all the more reason to make sure that you have exposure outside the U.S.
But you are sounding like we can kind of look through the political risk of the election.
We are. Yes, I believe we can.
No
and
doubt.
I say that as somebody who's studied politics for a really long time.
Yeah, that it's not different this time around or anything, right?
And again, I worry about everything, but I think the right thing to do is for investors to look through it.
All right, I think we're going to leave it. What? You look
Yeah,
like...
I guess, I mean, my
What?
question though is there's a lot of hay being made about, and Carol mentioned this, about the fragility of institutions in the U.S. And with a Supreme Court that some would argue gave the president much more power in a recent ruling. Why doesn't it concern you?
So it does concern me. I don't think it's necessarily something that we should be investing on our portfolios with. And when I ask people, do you feel like political polarization has grown in the U.S.? Everyone nods their head yes. But then I show stats showing that this has been a growing trend for over 40 years. And it's happening not just in the US, but outside the US as well. So this is a global phenomenon, and it makes governing very, very tricky. So it makes government harder to actually implement, but it's not necessarily going to start a crisis, right? And that's what you're going to worry about from a portfolio perspective.
So even another contested election outcome, you're saying
Look, it's not good,
Yeah.
but I don't think it's going to change the trajectory of the S&P over the next couple of years.
All right.
And that's the key.
All right. Going to leave it there. I know.
Nothing can stop the stocks, Carol. That's the message.
All right. Good to know. Thank you so much. That was good.
Thank
We
you.
just kind of went round and round with it, and it was fun to do that. Kara Murphy, she's Chief Investment Officer at the Registered Investment Advisor, Kestra Investment Management, joining us right here in our studio.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We have leaned on our next guest many times throughout the global pandemic and the days following the murder of George Floyd, throughout the twists and turns of the 2020 presidential race, and so much more. He is someone who's worked in leadership roles in both the private and public sectors, including a nearly 30-year career on Wall Street, which is why we love talking about him, about so much of what is the Bloomberg world. He is former Undersecretary of Commerce for International Trade at the U.S. Department of Commerce. That was during the Obama administration. Headed up the International Trade Administration. I could go on, but then we'd be done. Let's get to it. Stefan Selig is back with us, managing partner and founder of BridgePark Advisors, the financing advisory firm here in our Bloomberg Interactive Brokers studio. So nice to have you here with us. I do always like to lean on you to kind of connect the dots for us. This environment, I'm not quite sure where to start, but it does feel like politics is the right place to start in terms of what might happen in November. Does it matter who ultimately is in the White House come November?
Hi, Carol. Tim.
How are you?
I'm well, thank you. Too hot like everybody else, but at least cool in your studio. Look, I think it depends on what the issue is, right? And so some of the things we've talked about in the past, like China. This is one topic, where maybe the only topic, where Democrats and Republicans seem, quite aligned, which is getting tougher on China. I'm not sure policies will be radically different between a Trump and potentially a Biden administration. I think the deficit ain't going down with either president. I think defense spending is going up with either president. I think as a result of that, from an economic perspective, I'm not sure there's going to be a ton of difference. I think from a political perspective, clearly, President Trump is going to be much more isolationist. He is going to have much stricter immigration policies. And he is going to spend a lot of money. And so I think what all that does, which is why you're seeing the steepening of the yield curve, the so-called Trump trade that you've talked about, and the strengthening of the dollar, is, those are all going to be quite inflationary, especially if he adopts some of these more aggressive tariff proposals that he's talked about, both with China and in imports, which could be Trumpian hyperbole.
Right.
But if it does happen, inflation is going to go up dramatically. And
can you play that out for us? Because I think there's times in terms of, I think of voters who are just trying to pay their bills at this point. But how would that potentially play out and impact the U.S. economy and U.S. citizens?
Well, tariffs are nothing else other than, taxes, right? They're taxes on goods. And unfortunately, they're quite regressive because the people that are impacted most are, the folks that are paying their bills every month with groceries and car payments and everything else. And so prices will go up. There was not a very significant impact in the Trump original set of tariffs because they were not that significant. And President Biden obviously kept them largely in place. So the real question is he going to be much more aggressive in the next term? And if that is going to happen, some economists are talking about 100 basis point, 200 basis point increases in inflation, let alone about the impact and the slowing of the economy overall.
We have seen the narrative shift in the last 72 hours following the assassination attempt on the former president. Gone are the conversations dominated by who's going to replace Biden on the ticket, if anyone. And now the focus has been, especially with the RNC happening right now, on the strength of Trump's position, at least in the polls, and sort of a renewed sense of energy around him. You talk to CEOs all the time in your position at BridgePark Advisors. What are they telling you?
Well, look, I think you're quite right, Tim, that the narrative has changed on the one hand. But just to go back before we talk about the CEO perspective in a moment, I almost have a counterintuitive point of view, which is that strengthening of Trump from this horrific assassination attempt could in fact have an opposite of the Trump trade, which is this could be maybe an accelerant to having a changed Democratic ticket.
Really?
And if that were to be the case, just based on the poll numbers, you'd actually argue for taking the opposite side of that trade, because now Biden looks so much weaker than even he did after the debate that may force Democratic leadership and the president himself to really reevaluate whether or not he wants to stay in. And I have no perspective on whether that is going to be the case or not, but it is interesting that the strengthening of Trump could have that potential outcome.
Do you realistically see a scenario in the next few weeks where there is a change at the top of the ticket? I mean, the president did reiterate to Lester Holt last night that he's in it to win it.
Yeah, we've all heard the same thing on the one hand. On the other hand, despite what you may think about the president and some of his policies, I believe he is a true patriot and he wants to do the right thing for the country. And if he becomes convinced that he is not going to be able to beat Donald Trump, he may change his mind. Because at the end of the day, this is not just a narcissistic decision. It is a decision that many people believe is going to fundamentally affect, and I'm sure he does, the direction of this country. Going back to your question about CEOs, what I would say is, first of all, most Fortune 500 CEOs are Republicans. So, I don't know, polls have been taking 75% are Republicans. So you're starting with a base that most CEOs of big companies would vote for Trump kind of along party lines on the one hand. On the other hand, for this particular candidate, in the conversations I've had, I don't see much enthusiasm. For one, I don't think they appreciate his style. Two is some of these policies. CEOs are not isolationist. They are not xenophobic. They are not protectionist. They don't like tariffs. And so they don't like all of the social policies that are being talked about, for example, LGBTQ rights. And so while I think on the one hand, many of them are seeing the writing on the wall, and as a result, not standing up and lining behind President Biden. On the other hand, I don't think there's a lot of enthusiasm for this particular president as much as there is enthusiasm for traditionally centrist Republican policies as a way to drive corporate profits and corporate prosperity.
One of the things that we've been talking a lot about is kind of the establishment folks in Silicon Valley, or really in kind of the venture startup world, and their backing of Donald Trump and J.D. Vance, it seems like at this point. Why do you think that they appeal to them? Is it tax? What is it?
Well, part of it is J.D. Vance, had a job in Silicon Valley for a while, and so I think there is a little bit of a connection that he has personally with some of those folks.
But Peter Thiel and Elon were backing Trump for a long time.
Yeah, and I would say, frankly, Carol, those are not really representative of the Fortune 500 establishment. Traditionally, now it may be the new world order, but it certainly wasn't the world order of the last generation.
Well, is it important to make that distinction? Because it's interesting; they're in the headlines a lot.
Sure, but they're in the headlines a lot because of the huge wealth and success of Elon Musk and a number of other folks that like to comment on this. But traditionally, corporate CEOs are going to be much more reticent for making public political statements,
right,
because it's kind of not their lane and not their job. So as a result of that, you kind of have the squeaky wheel sort of phenomenon where you have folks like Bill Ackman that like to comment on these things, and Elon Musk, because of X and other things, that likes to comment on these things, where traditional corporate executives, I think, because their customers and their clients are both Republicans and Democrats, are quite chary about being as vocal.
Remember the Whole Foods founder who we spoke to?
I was just thinking about that.
Yeah, we spoke to John Mackey a few weeks ago. He's got a new book out. And in the book, he writes about the time that he weighed in on Obamacare and how it was such a disaster. And he said the board told him, never again, ever
don't touch
weigh in on anything.
The cutest story, Tim, that I've heard about that was a comment that Michael Jordan made.
Yeah.
And he said, guess what? Both Democrats and Republicans buy sneakers.
Yeah. Hey, well, speaking of that, we did just speak to Kara Murphy over at Kestra Investment Management, and she encouraged our listeners and our viewers to look beyond the election and argued that who's in the White House really doesn't matter when it comes to financial markets. That said, we spoke to Reid Hoffman, the LinkedIn founder and billionaire, about 6 weeks ago over at our San Francisco conference, and he said it absolutely does matter because he's concerned about a lack of stability as a result of a Trump presidency. What side are you on? Does it matter who's in the White House?
I think of course it matters, but you also have to ask that question in conjunction with what happens to the Congress. And is it going to be a divided government or not a divided government? Because that is a natural check and balance that I think will cause some of the more extreme outcomes from taking place. What I would say is, the United States position in the world will clearly be different between these two governments. And, former President Trump and President Biden have a different worldview in terms of cooperation, internationalism versus isolationism. And that is going to impact not only the citizenry, but impact businesses in many respects. And so I don't think it can be ignored. I am not quite as alarmist as some folks in terms of the end of democracy and civil war and some of the other things that some people are talking about. On the one hand, I do think this is an important election, and we need to be rightly talking about the issues.
Stefan, do you feel like you worked within the government, the Obama administration? Do we still have checks and balances? And will we still, depending on who's in the White House come November?
Obviously our system hasn't changed. What has changed, Carol, is we used to govern from the middle. Mm-hmm. And now we're governing from the extremes in both parties. And that is what creates a lot of, I think, these tensions and a lot of our ineffectiveness in terms of our ability to implement any policies. And I think, frankly, and this is my personal point of view, until we get back to the middle, we're going to have some real issues, because that's what creates the animosity and the ability to collaborate. And when President Biden was in the Senate, he was notoriously well known, and rightly so, for actually being able to collaborate across the aisle. And you don't see that from either party at the moment, and I don't see that changing with this election in either direction.
You did say until we get back to the middle, which strikes me as really optimistic. Do you see within? I mean, it's not an.
I think he said he was an optimist.
Within our lifetimes, we get back to the middle.
I don't know, Tim. You may as well be hopeful, because it's better than the other choice.
Yeah,
that's fair. Your clients, what do they ask you most about, and what are they up to?
Well, I think at the moment, as you rightly said, there was a whole conversation around what was going to happen on the top of the Democratic ticket, then the implications of the assassination attempt, clearly. But I think there's still a lot of uncertainty in the economy. And you guys spent a lot of time, understandably, talking about the markets, but the markets and the real economy are divergent. And the fact is that despite being at all-time highs in the equity markets, consumer sentiment is not high. Savings are being depleted from the pandemic relief. Inflation is going up, costs to consumers are going up, car payments, mortgage payments are higher because of interest rates, and that's creating a real sense of a lack of prosperity with most American households. And households, Carol, you know this, households don't own a lot of stock.
Right.
So all of that good stuff that we talk about in the equity markets really doesn't impact households traditionally. And even that high equity market, and you guys talk about this all the time, it's really technology. And it's not just technology, it's a handful of companies in the technology sector.
If you could change one policy that would help more Americans, because you're right, the market is not Main Street, what would it be, though?
Oh, I'd probably, it would be a political thing, and I'd probably have term limits to have us govern more effectively.
Yeah.
So I guess that would be my answer.
We just talked about car repossessions rocketing higher in the first half of the year. Carol asked you about one policy you would change. Though in the last 30 seconds that we have, why do you think that so much of America is struggling at a time when the economy is so good for so many people?
Well, I don't know, Tim. Is it so good for so many people? There's a real wealth gap, and it's good for a lot of, I think, your listeners who occupy a certain economic position in this country, and I'm not so sure it's so good for so many people. A lot of people are struggling, and that is why this populism that President Trump and J.D. Vance espouse has become so popular. And I think, we can't ignore that. And, we can all have stylistic concerns and concerns about some of their policies, but the people, the Americans that they are talking to, really feel what they are trying to address.
Yeah, I think it explains very much the political environment that we are, not just in the United States, but really globally, right? In terms of people not feeling that they're doing better.
For sure. And, Brexit, the elections in France, et cetera, et cetera. I mean, this is a global phenomenon.
Thank you. As always, Stefan Selig. He's managing partner at BridgePark Advisors.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
You all might remember on Friday, Carol and I were talking quite a bit how we plan to move to the French Riviera to broadcast our show.
Over this story.
Okay, before we were even done talking about it, we got a message from management that said, no, don't even think about it.
No remotes.
The reason we were talking about it, though, is because the French Riviera is so hot right now. Prices of homes valued above $16 million along France's southeastern coast rose between 15% and 20% in the 5 years through 2023, outperforming the 13% gains in London in the same period. That's data from broker Beauchamp Estates show. For a view of the luxury real estate market closer to home and around the world, too, we welcome back Daniel de la Vega, president of One Sotheby's International Realty. Daniel joining us from Colorado. Daniel, how are you?
I'm great. Thank you for having me back. Excited to be back on the show.
Well, Sotheby's International Realty just out with its mid-year luxury real estate report, and it shows that luxury properties are performing better than non-luxury properties. Is this all just because of rates and the folks that you're selling to don't care about mortgages?
The folks that we sell to do care about mortgages, right? Their businesses are affected by mortgages, but our luxury market in South Florida is performing better than any other. I mean, it's definitely performing better than the French Riviera. I heard you guys just talking a little bit about that. Our single family home market, the $10 million plus market, for sale product is up 30%, sold is up 35%. Pendings are up 30%, and the average price per square foot is up 11% to $2,400 a square foot. Those are unheard of for our market. And then on the condo side, it's even higher. Right? For the $10 million plus market, for sales up 37%, solds up 20%, pendings are flat, but the price per square foot is up to $34.51 per square foot. And that's inventory that's on the market. Those are numbers from the local MLSs. That doesn't account for new developments, which trade for traditionally 20 to 30% above what's on market. So, interest rates aren't really affecting us. I think that everybody's kind of bullish that interest rates are going to go down. And like they say, interest rates are temporary.
All right, interesting. I do wonder, though, if rates go down and people kind of like, it doesn't pay as much to leave my money in cash, although we're not, down to zero or anything like that. Hey, having said that, Daniel, what's always important, I feel like when we have a conversation with you, this is a very kind of narrow part of the real estate market, although obviously a luxe one and a high-end one and a pricey one. How does it compare to pre-pandemic levels, what we're seeing today?
Oh, you have markets that are up 300% in some instances. I mean, it is a completely different market, especially in Florida. All the job creation.
So stronger, hotter than it was pre-pandemic?
Way stronger, way hotter. Yeah, I mean, those numbers that I just gave you were year-to-date numbers. So we've had an incredible first half of the year here in Florida. And most of my colleagues that I speak to across the U.S., I mean, I'm sitting here in Aspen, Colorado. The market's performing incredibly well. And it's a lack of inventory. People don't have homes to sell. People don't want to sell their homes. They have locked in low mortgage rates. And while mortgage rates are coming down, we're very bullish that they are going to come down. We saw the CPI numbers close to 3%. We saw unemployment up to 4.1%. We're bullish that they're going to come down. Canada's about to lower for the second time, and inflation hasn't come down after the first. So very, very positive outlook from that standpoint, but it's an inventory crunch. There's still not a lot of inventory on the market. Most markets are averaging still below a 6-month supply, which is what we look at as our baseline average.
Daniel, is the idea of climate change, rising sea levels, increasing volatility of storms, is that on the radar at all of your clients in South Florida?
It has its moments. You have sometimes articles published about sea level rise and things like that. And we're trying to be as resilient as we can in Florida. It definitely has infected insurance prices. Insurance prices have doubled, sometimes tripled, especially waterfront properties that need wind mitigation. So, it's something that's it's on a case-by-case basis, but it's not something that's happening at a more macro level. You're seeing people talk about it as they price their insurances, say, whoa, this is a lot more than I expected. But, the same thing goes for taxes in Florida, right? I mean, taxes in Florida are high compared to other states. We average 1.875% as property tax. States like Colorado, they have very low property tax, but we still continue to have people want to purchase, want to live, want to build their careers in Florida. So, it's something that I think is going to be temporary. It's going to have to be fixed at a federal level, and I'm bullish that our government will fix it.
You think insurance has to be fixed at a federal level?
I do, especially in Florida. Yeah, it's going to have to be a federal issue.
That's interesting, because Texas and California are also running into some serious insurance issues. Here in New York, too, I think a lot of homeowners would say that their insurance rates have gone up.
Texas?
Yeah. I mean, I just play that out a little bit for us about how that would work nationally, because that's an interesting solution that I haven't heard about.
Look, I don't know how it would play out. I'm just hoping that the Fed does get involved at some level, create some subsidies for us so that we can make insurances across the country affordable, because while it's up 3 times in Florida, to your point, it is up. It's not 2% of property value, but it's still up in Colorado. It's up in Texas. So, I think there'll have to be some sort of subsidies created at the federal level.
What might surprise someone who is listening right now, the Bloomberg audience, about your world?
You know, what would I was looking at some, you know, the election is a big topic. And I think what people fail to realize is that property values have gone up in 9 out of the last 11 elections. And 8 out of the last 11 elections, mortgage rates have gone down. So I'm very bullish that with interest rates coming down, statistically speaking, they go down, and then the pent up demand after the election, and again, statistically speaking, there's a lot of pent up demand, and you know you have 9 out of the last 11 elections an increase in property values. I think we're in line for a really good, strong Q1 2025. We might see a little bit of a slowdown, pre-election. Interest rates are obviously going to help with that. But still, I think the first quarter of next year is going to be really strong. And we're very bullish on what's to come.
What's the, outside of the South Florida market, what's another market that needs to be on the radar of our audience?
You know, I keep reading that New York's a buyer's market. I'm still very bullish on New York. I love Manhattan. I think the arts and the cultural scene are out of this world. The restaurants are still great. The people are still great. They have some of the best colleges in the world. So if it's a buyer's market, like everybody's saying, I would double down on Manhattan.
Interesting. Okay. Some optimism about Manhattan.
Yeah, exactly. Really interesting.
I just have a long-term view on things in general when it comes to real estate, right?
Hey, one last question. Who are mostly your buyers at this point? What's the demographics of it? Is it folks in the United States? Is it global buyers? What is the age? What can you tell us?
Yeah, we're still seeing a lot of Northeast buyers. We're seeing a lot of millennial buyers, actually. I think this $16 trillion, the generational shift of wealth, I think is a really big deal from the baby boomers to the millennials. We're seeing a lot of properties being bought in trusts, right? We're seeing a lot of that in the new development space. We represent a lot of new developments along the east coast of Florida. And then, Canada's still the number one buyer in Florida, although they buy at a lower price point. We're seeing Texas, we're seeing a lot of California and Mexico. Mexico's a huge market for us. Yeah. And then Latin America has always been a big market for us. And it kind of depends on what's happening at a local level in the countries in Latin America.
All right, we're going to leave it on that note. By the way, Elon Musk might be looking for a house in Texas because that's where he's moving his SpaceX headquarters to Texas from California. I know he's been out anyway.
I mean, yeah.
And did he sell all his homes also?
Yeah, he's been out.
Trying to make a segue.
I know, but I do think this is more symbolic than it is. I mean, Tesla's already moved production there. Move Sorry, I don't mean to rain on your parade.
That's
but,
all right. It's kind of that kind of a day. Daniel, be well. Daniel de la Vega, he's president of One Sotheby's International Realty, joining us from Colorado.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
You drive me crazy.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, TikTok, everybody. Coming up on 18 minutes left in the trading session, getting ready in just a bit. We're going to head over to our TV colleagues, counting down to the closing bell on this Tuesday. In the meantime, we're going to talk a little bit more about this trade.
Yeah, we got Kristy Akullian with us, head of iShares investment strategy over at BlackRock. Kristy, good to have you with us. iShares just out with its mid-year. Everyone's out with their mid-year report.
I know. What is that?
It's because it's the mid-year.
Oh, it's the mid-year.
That's what it is. Yeah. You and the
Can
team
we do
write
a mid-year report?
Report card.
Oh.
Yeah, mid-year review.
We do have mid-year reviews.
Yeah, I was going to say, you better get on top of that. If you don't know, we have that.
We do have that.
Kristy, I do want to talk about the iShares mid-year report because you and the team write that since our last outlook in March, a broad sampling of data reflects a U.S. economy with substantial growth momentum. How much momentum does the economy have?
Yeah, and thanks for having me. It's so great to be here today. So I think that one of the biggest differences from what we were talking about earlier this year, and certainly coming into this year, is really just that the economy has remained a lot stronger than expected. So we've really taken out a lot of that left tail in terms of the recession risk. And so we've seen the economy, it stayed a lot stronger than expected. And I think that it's in a really benign deceleration mode right now. So we do expect growth to slow, but we don't expect it to slow so much that we're going to get that bumpy or that hard landing that maybe investors thought we were going to get in December.
No recession at all?
Right now, it certainly doesn't look like it. Right now, it does paint more of a soft landing picture. And I think that that's part of what encourages us in this mid-year outlook, as you referenced, to lean into risk. But I think that there's a difference between leaning into risk and then just indiscriminately reaching for risky assets. And that's certainly not what we're talking about. A lot of the themes that we're talking about there are quality. So something like QUAL is a ticker that we have had top of mind and top of investor minds as well, too. As we think about staying invested and leaning in a little bit, but doing so in kind of a sensible way that screens for higher quality.
Kristy, what was the moment or the piece of data, or what happened when you said, we're going for a soft landing, we're full on soft landing here? What was that moment that you decided that this was the narrative we're going to adopt?
I don't know if it was one specific moment so much as a collection of moments and data that we've gotten over the course of the year. So maybe kind of an unsatisfying answer. I think GDP growth came in a lot stronger than we expected in Q4, a little bit softer than expected in Q3, but still twice as strong as investors expected coming into the year. So, I think maybe that headline number matters. But yeah, I think it really is just the broad sampling of data that makes us feel more comfortable that it's not just that one single data point.
It's interesting. I'm looking at the iShares quality, as you said, QUAL is the ticker. And, if I look at some of the holdings, they're well-known names and some of the big mega cap tech names that have really pushed the overall market higher. So it's NVIDIA, it's Apple, it's Microsoft. To be fair, there's also Visa. Meta's also in there. Costco, Johnson & Johnson, and I'm looking at a performance over the past year that's up about 29% here, 5-year up about 15% on average annually. It's kind of interesting. Does it still make sense to be somewhat passive and just buy the market at this point?
It's a great question, and I think it really depends upon investor preference here. I think there's a lot of investors that we speak to who do prefer an index exposure, and for that, we like quality. For investors who maybe are comfortable taking a more active approach, we've got some great offerings there. The one that we've been talking about a ton and really, I think is made for these times is DYNF. So that is our dynamic factor rotation fund. It still looks a lot like quality right now, but because of that active management tilt and strategy that it follows, it can change a lot more quickly than an index fund can. And so what we're seeing is that as we're approaching this period where is the Fed going to start to cut? Is inflation going to start to fall? We're seeing these inflection points kind of form in the market and on the horizon. And I think that investors who want to be able to take advantage of that are leaning more into active strategies, and we've seen that in the flows.
Help me out, though, because I look at the top holdings in this one, and it's a lot like the last one we just talked about, QUAL, NVIDIA, Microsoft, Apple, Visa, Meta. So help me understand, constantly it's really some of these large mega cap names that really provide the momentum for, even though you call them different things, it's really the same names that are really moving the needle.
A lot of the same names, it's at slightly different weights. And I think the importance is the rebalance frequency as well. So yes, the active fund looks very similar to the quality index fund right now because it chooses to be in higher quality names. What can change pretty rapidly, though, is it's actually started to dial back a little bit of its quality preference, and it started to tilt up a little bit of its value preference. So that faster rebalancing schedule just means that it can move more quickly with the markets, even though, all of these funds are going to, in broad strokes, still sort of represent a market cap weighted index as a starting point. And then they're going to make adjustments from there.
How are you thinking about themes that you don't have ETFs for right now? What's when you go into the room at BlackRock and you talk about, themes that you want to sort of adopt moving forward, what's interesting to you?
Yeah, so there's a lot of growth in alternatives, right? I mean, I think that is a big part of the focus. Right now, I think we're talking more about some of the liquid alternative strategies. So things that can still be, invested in via a mutual fund wrapper, for example, and that can still offer sort of daily liquidity and whatnot. But I think that as the market matures and as, the ETF industry expands and also other fund wrappers, we're looking at things like private markets as being opportunities and where and how those can fit into different investor portfolios. So I think a lot of the excitement and sort of the new frontiers, if you will, are sort of in that alternative space. But, even now, if you just look at some of the launches, if the proof is in the pudding, if you will, a much larger share of ETF launches don't look like ETFs in the past. So about 41% of all launches that we've seen so far this year have been active. And that just lets them do different things and play in different markets than maybe people thought about ETFs traditionally. So even within the ETF wrapper, the investment profile is changing. And outside of it, I think it's looking and pushing that frontier in terms of alternatives, liquid alternatives, private markets, things like that.
I mean, what do, like when you guys talk to institutional clients, just got about 25 seconds left here, or investors in general, what other kind of devices or ETFs are they looking for to play around with in this market? Just real quickly.
Yeah, again, I think a big part of it is active strategies,
okay,
but outcome strategies. So things that are using derivatives to either enhance income or define more specific outcomes. I think that's a really quickly growing category for a lot of investors and institutional in particular too. And a breaking news for you here is just today, iShares reached $4 trillion globally in assets under management. So that's a new stat.
All right. Well, we'll take it. Hey, listen, thank you so much. Kristy Akullian, she's head of iShares investment strategy over at BlackRock, joining us from San Francisco.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.